So yeah, I sold my little fledgling bail bonds agency for $30,000 to one of my top clients who was a drug
Oh,
dealer. He goes, "Okay, now you can pay." And this guy pulls out tube socks, starts dumping rolls of $100 bills.
so for
Yeah.
me it's 300 where that blockade is coming in.
To get past 500,000, you have to get somebody else doing the work. At 2 million, the next bottleneck is that you just can't sell anymore. At 10 million, you have to strip out all the low margin services to scale. If you don't have $100,000, then just start, build the lifestyle firm, get up to $100,000, $200,000 of revenue or so, and then go meet with an SBA lender who will give you an expansion loan where they'll use the value of the firm that you have bootstrapped to then get into a business without having to put any money down.
Daniel Talbott, welcome to the show. It's amazing to have you here on the Fun CPA podcast after meeting in person in Colorado. So how have you been since I saw you back in July?
Hey, thanks for having me. And good, business is good. So I'm
Awesome.
excited to chat with you.
Yeah, awesome. Always good to do it in person, but I don't always have all my podcasting gear. And that surprise I did for your for the little group you guys had, I just showed up, ate your food, and then we and then we hung out. It was cool, but no, it was nice meeting you there, and then bridging the gap. So it was really good stuff. For those people that don't know you, don't know who you are, can you give us a little bit like a 1 minute about who you are?
Yeah, absolutely. So my name is Daniel Talbott, and I am an M&A advisor to accounting firm owners in particular. I own RightExit. So we specialize in helping firm owners find the right buyer for the right price at the right time. But I haven't always been in M&A. I used to be, so I'm still an active EA. So I was a tax accountant, tax planner, owned a virtual firm.
Cool.
So yeah, just a lot like you, not too long ago.
That's really cool. And then before that, why don't you take us to your kind of journey of getting into accounting, which we talked a little bit about offline. But tell me some of that. How'd you get started in accounting? Yeah, and then we can dive into that.
Yeah, so we can drop the curtain, or pull back the
Yes.
facade a little bit. On LinkedIn, you pointed out that I have banker surety listed. That's because it tracks a little bit better than being a bail bondsman. So I was a bail bondsman, took over a family business called Dusk to Dawn Bail Bonds. Banker
Cool.
surety was the surety company we represented. So it's a
I see.
true statement, but reworked a little bit. But yeah, went into bail bonds right out of high school. Actually, I dropped out of high school to go into bail bonds.
Oh, wow.
So dropped out of high school, got my GED, took the bail bonds class test, got the license, went into the family business. My grandfather's agency, he had been in the insurance world for so long that when he got licensed, bail bonds was included like 50 years ago.
Oh, wow.
So yeah, he had just sold his insurance agency when I joined, and he was retired. So I learned everything under a manager. And a few years in, the manager quit. So I thought I had the opportunity to take over. It's a whole ordeal. My grandfather came out of retirement because he felt like I wasn't ready. But I was 22, so I knew everything.
Of course.
Yeah, so I went and started my own. A year later, found out the family business was up for sale. So I sold my business and for enough for the down payment to buy my family business. And then four
Wow.
years later, I killed it. I didn't know what a
Oh, geez.
P&L was. I was making more money than we had made before. I tried to open another office. I hired people, and
Wow.
I didn't. I mean, I was still doing the finances the way my grandfather did, balancing the checkbook on a big yellow legal pad the way he showed me.
Wow.
No P&L, no. I didn't know what to pay in taxes. So yeah, got slammed by a big tax bill and pretty well took me out. So I had a lot of newfound free time. I wanted to figure out where it all went wrong. So I went back to school for accounting.
Wow. That's pretty interesting. I'm actually curious. So, given where you ended up now with doing M&A and valuing companies and doing all that, I'm actually curious. Like, what did you sell your little bail bondsman business for? And looking back, like, do you feel like it was like a good deal, or were you just like, I'll
Oh,
take whatever?
these numbers are it's going to be so small compared to the things that we'll probably end up talking about now. Is kind of funny.
Yeah.
The family business was only up for sale for 300. I needed like 10%. I had a little bit of savings, so 20%
Yeah.
down. So yeah, I sold my little fledgling bail bonds agency for $30,000 to one of my top clients who was a drug
Oh,
dealer, and
wow.
he bought everything from me, the phone number, the name, the website, all my templates and processes for 30,000, and he paid me out of tube sock. He had rolls of kind of damp $100 bills in tube socks.
Wow.
Now we did this at a law firm, so that was the only legit part of any of this. Like,
Fascinating.
literally, the lawyer had us both sign the contract. He goes, "Okay, now you can pay," and this guy pulls out tube socks, and starts dumping rolls of $100 bills, thirty
Wow.
thousand worth of them. Yeah.
That is interesting. So you bought, okay, so interesting. That is
That was
quite
how
wild.
I
Quite
didn't
wild how,
I didn't put the down payment on the family business like that. I took
yeah,
it to the bank and actually
good.
wrote a
You were
check.
legit. That's very good. So yes,
Yeah.
so then you buy the family business back.
Yeah.
Now I'm assuming, I mean, it had to have been some sort of like multiple of gross revenue or whatever, or however it was factored to get to 300,000,
We
or
had
maybe
no
just
idea what we were doing. No, he just said
he
this is
just
what
wanted
I
that
want.
number.
Yeah.
All right, fair enough. And then you
And it
take
was
over it.
like, yeah, it was like, yeah, I'll take that down payment that you have, and you can make monthly payments to me until it's paid up.
All right, cool.
Yeah.
So then, and then taxes crush you. You know, you're doing well. You're growing the business. Taxes crush you. And did you sell it at the end, or you just
Yeah.
shut it down?
Yeah, we ended up selling it for,
Okay.
I mean, just it was basically somebody came and took over. At that point, the office building had more value than the business did, so it mostly
Wow.
sold the office building and with the business included.
All right. Interesting. So then we move on from that. That is quite the interesting story. So you realize then, I guess, hey, accounting is important, and then you went back. So you went back to school. You went to school for accounting.
Yeah. Yeah, so I went to school for accounting, and so I was still doing bonds a little bit here and there, but like you kind of figure it out after being in the business for a while. Like certain bonds, certain crimes, the court proceeding will take years, so you're stuck with that liability for a long time.
Wow.
So I was just working by myself and doing little like DUI and possession cases that I knew would turn over in 30 days. So I wasn't carrying a huge liability, but I could still make a little bit of money.
I
And I got
see.
my real estate license.
Yeah.
And so did a couple residential sales. But when I was getting my license, there was like one chapter in the book about buying and selling businesses. And that kind of
Interesting.
planted a seed that would take a long time to grow.
I also had the track of being a realtor for probably like 3 or 4 years, but it was during school for me, so it wasn't
Yeah.
like I didn't have any time to like actually go and like sit at open houses and all that. So I did it for a little bit, and then the license lapsed. But yeah, that's interesting. What's easier to make money on, being a bail bondsman or selling houses?
For me, being a bail bondsman was easier, but it's like it's a whole different process. It's
Yeah.
you have there's a sheet up in the jail by the phones of like a list of bail bonds agencies, and they cycle who's on top. So it's like you have these kind of ebbs and flows of when you're getting a lot of calls, when you're not.
Interesting.
But yeah, that's always been my kind of joke about how I learned sales. My way of learning sales was I would get a call from the most delinquent member of your family at 3 a.m. and then I have to call the wealthiest member of your family and convince them to come get that person out of jail.
That
Oftentimes
is
for
a
tens of thousands of dollars. So
Yeah, that is a tough business to be in, for sure. And that's if you can sell that, I feel like you can sell anything else. So you get through the accounting schooling,
yeah.
and then what'd that look like for you? Did you go to a firm? Did you go?
Yeah.
What did you end up doing after that?
I actually, so funny enough, I actually didn't finish. Like I have a history
Oh,
of dropping out of school. Uh, no, I got a job. So I tried to get a job in an accounting firm, just doing anything. Like I was like, look, I owned a business. I know I'm humble. I can be humble. I can start over. Like I'll open the mail, whatever.
yeah.
And couldn't get a job. So while I was in school for accounting, finally landed a job as a third chair paralegal to a tax attorney.
Oh wow.
yeah, it turns out I caught on with the numbers pretty quickly, and I had my own tax issues, so we did a lot of tax planning, tax remediation. I was pretty good at negotiating with the IRS. So really quickly worked my way up to being his first chair, being his right hand man.
Awesome.
Got my EA, and became an associate in the firm within the first year.
Wow.
So I was doing my own representation work and tax planning work, doing like corporate restructuring for small business owners. And then the firm decided to focus more on getting more high net worth clients, and like
Mm.
I wanted every small business owner I could get. I didn't really like, I didn't mind working with high net worth individuals. It just wasn't,
Yeah.
it wasn't what drove me. It wasn't my passion. So I started looking around for other options. I actually set up a consultancy because again, I'm like,
Cool.
oh yeah, I've done this for a year. I can do it on my own now. No,
I
I
see the
couldn't.
pattern.
Yeah, yeah. I have a habit of that.
Yeah.
But no, I ended up connecting with some guys in San Francisco that had started a startup focused on bookkeeping and tax for solopreneurs,
Cool.
and they had raised a little bit of angel investment, and they needed what a subject matter expert. I'm gonna put that in
Mm.
quotes because I had been in the business. I had my EA for like a year at that point, but they needed somebody who knew a little bit about something, and we ended up meeting in Dallas. We were just there at the same time by luck, and they offered me a job. So they moved me to San Francisco. I was the only native English speaker. They were both
Oh.
Turkish, the
Oh,
founders of the
cool.
company. So they made me head of sales. So I ran sales. The company would eventually rebrand. I think I can shout it out. It was Collective. It became Collective. It was Hike at the time.
Okay, cool.
Um, yeah, they raised $30 million while I was there.
Wow.
Raised another 50 after that. Like, so they've done very well. Still doing well. But I was there for 2.5 years. Led sales, built the sales team, worked as a tax professional, and so this gave me a really interesting insight into the world of CAS, especially virtual CAS,
Hmm.
because what we saw was when I joined, there was like 10 proof of concept clients that were being served by contractors.
Hmm.
And so while I was there 2.5 years, we built up from me being the first full-time hire to a team of 100,
Wow.
multiple offshore teams. We had 2,500 clients. So we went from 10 to 2,500 in 2 years, 2.5 years.
Wow.
So what we did in that period of time was in the beginning, I was doing a lot of the work. I was working with the contractors and I was doing a lot of the client facing. So we had accountants doing customer success. Then we outgrew that. So we hired customer success managers. And then we outgrew that and had to build pods. And
Wow.
all of that happened in such a compressed period of time. So it was like what you would learn from scaling a firm over 10 years or 20 years, we got to see in 2 years.
Wow. That's pretty
So,
cool.
yeah. So
And then,
it was a fun experience.
yeah, so you grow that. I mean, that's pretty wild success there. Now you mentioned that name Collective, then I was like, wait, I actually keep seeing Instagram ads actually for
Yeah.
Collective.
I was
So that's
the
actually,
S, everyone should be an S Corp guy. I was one of those people.
yes, yes, I saw that a lot. I've been seeing. I'm like, well, my thoughts on that aside, I'll
Yeah.
digress on that one. But so then you do that, and then when you finished up there, where did you go after that?
Yeah, so got to a certain point where after a couple rounds, they started hiring like directors and VPs from other startups.
Mm.
And a mentor of mine within the company basically said, like, you don't have a chance at getting one of those roles until you've worked for another startup. And I was like, well,
Mm.
that's dumb. I don't want to
Right,
go anywhere. He's like, that's just the way it is. Like the investors are going to insist that we hire people from that have that experience.
right.
So I said, well, what do I do? And he said, you go get a job somewhere else. So I sent an application into a competing company, so very similarly positioned, but focused on real estate agents. That was formations. And it was kind of cool. I sent my application in, and like within, I talked to the hiring manager, and like within a half hour, I was on the phone with the CEO,
Oh,
and he's like, "Yeah, we want you to come work with us." So
cool.
yes, I jumped over and joined them as a senior tax manager. I ended up heading up the 1120S production for that first season while I was there, and then
Cool.
launched the cast team before I went out on my own.
Oh, okay, cool. That's awesome. And then since then, you've been on your own. So you've had your like a tax practice of your
Yep.
own.
Yeah.
Now
So
you're still
yeah,
doing that too?
launched. Yeah, so in between collective and formations,
Yeah.
some of the influencers, we had influencer referral partners. I
Mm.
had developed those relationships, so they didn't want to. They wanted to follow me, but they didn't want to go from one startup to another. So I ended up starting a little side hustle, doing some bookkeeping and tax
Cool.
while I was working full time. And I just couldn't figure out how to get enough bookkeeping and tax clients to cover my full time salary.
Mm.
So I started offering fractional CFO services. And fractional CFO was what ultimately bridged the gap for me, but also got me a taste of M&A. So I ended up with a client, a tree service in Washington, that wanted to grow by buying a landscaping company. So
Ah,
I
interesting.
was involved on the financial side of that. And then one of the clients I got was like a real estate investing education business that turns out they brought on a fractional CFO because they wanted to sell, and the
Yeah,
broker was having a hard time with the finances.
interesting.
So I got to work, kind of hand in hand with a broker on that one. And then I saw what the broker made, and I was like, man, I could do that. I could do that job.
Interesting. So you get quite the journey, quite the entrepreneurial moving around journey to figure it out. And I like that you had that exposure to the fractional CFO and M&A work earlier on, because I think a lot of times, like every once in a while, I'll get looped into something like that, where you gotta like evaluate or evaluate a company that either a client wants to buy,
Yeah.
or just figure out whether they're getting a good deal on their sale. So let's dive into that. Let's talk about the whole M&A space for accountants now. I've been seeing such a huge uptick, and I don't know. Maybe I could pick your brain about what you think is
Mhm.
causing that, but specifically an uptick in buying firms by non-accountants. Like, are you
Oh
seeing
yeah.
a lot of that too? And why do
Yeah.
you think there's that big push?
I mean, I think there's probably so one, the accounting industry is just really attractive anyway. There's a lot of opportunity to really quickly make small changes to get a massive ROI. So
Mm,
there's plenty of firms out there that just not on the most recent technology. They're underpricing, so the firm is undervalued. So and the tolerance of the market, of any market across the country, to endure price increase is way the tolerance is way higher than a lot of firm owners think it is.
that's
So
true.
it's just an attractive asset on that side. But then there's a ton of these like entrepreneur through acquisition type influencers like
Hmm.
Cody Sanchez and Walker Diebel, and
Yeah.
they're strong advocates for investing in accounting practices. I think that's driving a lot of non-accountants to the space as well.
Interesting. So I've heard that name, the Cody Sanchez. Obviously, I've actually I listened to the Diary of a CEO podcast with Stephen Bartlett, and so she was on that recently. But
Mm.
interesting, because I've been at Bridging the Gap. Actually, met a couple folks that were literally just there to talk to accountants because they wanted to buy accounting, but they had no accounting background. So that's fascinating to me.
Yeah.
I do agree with you on the whole like ability to raise prices. And I think we accountants are often our own worst enemies when it comes to like pricing. And so I guess the direction I want to go with this is like, what do you find? Do you find that the majority of the deals, like, is it older folks that are looking to retire? Or do you find that it's like younger people selling? Like, what's the demographic like?
Yes, I mean the silver tsunami, as you may see online, the baby boomers mass retiring, like that's relevant in this industry too. I think it's a
Yeah,
little bit more compressed than other industries because you can do tax returns at 75. You probably can't put a new roof on a house at 75 anymore. So
fair.
like, so we're going to see the silver tsunami effect in accounting a little bit later than other industries have. So that's like the market. And then personally, I think it's just because I'm younger and because of where I market myself, I end up attracting firm owners who are like 35 to 55 that are either going full time as a CFO. They're going to peel off their fractional CFO engagements and then have more work life balance, or they are going to get into investing, get into real estate investing, sell
Interesting.
off, and spend more time with their kids. It's like more lifestyle changes that I'm personally seeing than those
Interesting.
retirees. But we do work with retirees as well. We've got one right now. That's the
Yeah.
case.
Interesting. I'm curious about, so the folks that you just mentioned, 35 to 55. What are you seeing as like the breakdown of their firm dynamics, right? So I say this because when you mentioned to me that they're looking to like offload their lifestyle, clearly they don't might not necessarily have a lifestyle firm, right? Because if they had a lifestyle firm, they would probably not need to sell,
Yeah.
So the firm, it seems the way I'm reading what you're saying, is like they are just overwhelmed by their firm. It's taken up a whole lot of time and they just want to divest and whatever it is. So what are you seeing? Like what does that look like client number wise on average, maybe if you get
Yeah.
an idea, and fee wise?
Yeah, I'd say probably around 2 million in revenue.
Wow.
Fee wise, yeah, I mean they're good fees. 600 to 700, $10 1040s, 1,200 to $1,700 1120s, 1120s. 1120s could be higher into the 2,000 range. So we typically see bookkeeping on average $500, 500 to 700 a month. That's kind of like the sweet spot.
Okay.
I mean, like if I was going to start all over again, I mean, 100 clients paying $500 a month for tax-ready books would be like the most scalable, sellable firm that you could throw together.
Interesting. Yeah, that's cool.
Yeah.
But on that, I'm wondering. So you got 600 to 700 on average on 1040s and 1,200 to 1,700 for the S corps and all that. I mean, they must have a ton of clients to get to 2 million.
Yeah. Yeah,
I
there's
mean,
so there's a lot. And so there's like these stage gates, and this has just become more and more validated, not just from conversations I'm having with firm owners, but other M&A professionals in the space, other consultants as well. But there's these kind of plateaus or gates that you get to when you're building your firm. As a lifestyle firm, doing a lot of the work yourself, maybe with a helper, you can get to about 500,000. I have seen
yeah.
750. I've seen more stuck at
Wow.
300, right? But like 500,000 is a pretty good number. To get past 500,000, you have to get somebody else doing the work, like the deliverable.
Hmm.
Once you have other people delivering the work, you can comfortably get to like between 1.3 and 2, sorry, 1.5 and 2.5 million. It's like, so right around 2 million is where you get to. At 2 million, the next bottleneck is that you just can't sell you can't sell anymore. Like you're
Hmm.
tapped out in terms of your capacity to sell services. So you either bring on a partner the old school way and you make
Yeah.
them sell services, or you hire sales professionals, and then you'll grow up to about 5 million, and then you have to empower managers who are hiring people that you have never interviewed, or maybe you did like a culture fit interview or something, but you have other people who are building your teams, and then you're
Interesting.
you're pretty good until 10 million. At 10 million, you have to strip out all the low margin services to scale
Wow.
or acquire.
That's interesting. Yeah, I like that. From my own experience, and as a lifestyle firm, for me, it looks like I know I was post about it, but I'll dive into it. So it's under 40 hours a week, any time, all year long, tax season included, and then off tax season, I'm at 10 to 15 hours of actual work. But right now, to be honest with you, I'm hitting that kind of cap as to my ability to like serve the clients and do everything that I'm doing and keep to my hours that I've referenced, like that I just said. And
Mm.
I'm gonna hit 300. So
Yeah.
for me it's 300 where that blockade is coming, and that's with a helper on the bookkeeping side. Like if I had to do the actual bookkeeping stuff, like then I don't even there's no way, there's no way I would
Right.
do that. But those are some interesting kind of blocks, and I've heard what you said echoed from firm owners'
Mm.
perspectives. That's where they keep hitting this plateau to the exact things that you've mentioned. What's your advice, or what's your thought process as far as like, should someone scale to the next level, or should they just stay at where they are? And I asked it partially for myself and partially for the listeners too.
Yeah, so I'm extremely biased on this question, but and maybe this is going to be polarizing, but that's what we do on podcasts, right?
Yes, exactly.
I have young kids, and I'm in a similar business now. Like I could make a good 6-figure, maybe even low 7-figure income working basically by myself. But if I got hit by a bus tomorrow, then my kids have nothing other than my life insurance.
Yeah.
So I believe even in the business I'm in now that I want to build systems and empower people and build a model that's scalable so that I have a sellable asset. Or if something happened to me, then my wife and kids would have a sellable asset.
That's a really good point. I mean, definitely, definitely some food for thought, because you're right. When you look at it in that perspective, then yeah, like God forbid something happens, and like obviously the business will not continue working because there's nobody else working it. The offset to it, I think, at least from my perspective, and the conversations I've had with folks, is the hours, the grind, and everything you got to do to set that up, then also obviously takes away from the battle. So I feel like the battle is like the die hard lifestyle folks.
Well, and so I could push back on that
Yeah.
because so there's multiple types of businesses out there, right? And I think that a lot of tax firms, maybe accounting firms as well, see something very similar to like an HVAC company or a plumbing business. When you have a technician who becomes a technical business owner, they get stuck at kind of the same spots. Now, the different industries have different levels they get stuck at because of growth requirements.
Yeah.
But tech is a great industry to look at because tech founders reinvent themselves at each new stage gate. And so it's just in a mindset that you have to adopt as a tax professional, that if you want to build a sellable business and you want to maintain a 40-hour work week, at some point you're not preparing tax returns anymore. At some point you go from being that technical preparer to full-time tax planner to full-time salesperson. And you just have to embrace those evolutions as the company grows and you develop new roles for other people to take over.
Yeah. Yeah. No, that's a really good point too. And I think the toughest thing as that practitioner, as the technician, like myself, is the point where you got to bring somebody on, you're worried about obviously your own bottom line, with a bottom line of say 250, 260, or whatever it is, maybe, 220, whatever it is for the person on 300 grand of revenue, you're saying to yourself, okay, if I bring somebody on, it just becomes a scarier thing, obviously, to bring somebody on and to step away from that and to have that period of time where you're going to see a big drop in your profits. Mm-hmm. It's interesting because the folks that I talk to, like some people just, blatantly don't care about that aspect. Like it doesn't bother them, They're like, okay, it's just a cost of doing business and see you profits in 3 to 5 years.
Yeah.
You know what I mean? I know Roman Villard, for example. I talked to him, and I feel like he's very much of that mindset when I met him.
That's because we have a very similar background. He was also head of sales in an accounting firm. So
interesting. I feel like you have to have that background, and especially with your experience of having grown something so much and developed all those processes and brought people on and scaled a company that was not necessarily yours, right, at the time, to see that impact, growing it to 2,500 people, the collective, probably helps tremendously in understanding that.
It definitely gives you, it eliminates the scarcity mindset, and it teaches you the skills of building a pipeline. Because sales, you don't have to be all that good at sales. If you have enough pipeline, you'll grow your business. So it's just about knowing how to develop a pipeline of opportunities, and then dropping your your cash flow by $100,000 to hire somebody just isn't as scary anymore when you know how long it'll take for you to recoup that.
Yeah. That's a good point. I want to switch gears a little bit now to so when the time comes for these folks to be selling, the people you mentioned, $2 million or 1.5 or whatever it is that you're seeing,
Yeah.
how are you seeing the valuations done? So I've heard it's a multiple of gross. I've heard a multiple of EBITDA. I've heard all kinds of things. What are you seeing out there right now on the deals that are in front of you?
It's going it's changed so much just in the last 12 to 18 months.
Interesting.
And right now firms, tax firms, so it depends on where your revenue is coming from. So I posted about this recently on LinkedIn that your revenue is essentially falls into one of three categories. It's project based, so maybe like bookkeeping cleanup.
Yep.
It's reoccurring, so happening every year, but you get paid once a year, like tax prep, or recurring, which would be like your monthly bookkeeping.
Interesting.
And your like project work is probably worth one half to one times revenue, just because you don't know if it's going to come in again. So audit firms are really difficult to sell for me anyway.
Interesting.
Reoccurring revenue, good reliable tax clients that have been coming for years, they're probably worth one times to one and a quarter times revenue. And then your recurring work like bookkeeping, ongoing fractional CFO or advisory services, those are going to be worth anywhere from two to even as high as three times revenue.
Wow.
Now, all of this does fall back on an underpinning of EBITDA. So you have to have a profitable firm, you have to have good margins. So under 5 million, it's pretty likely that your firm's going to be bought by someone using a loan, like a SBA 7A loan program, the loan program to get the business. So that that loan program, a lot of banks will do like a 1.15 to 1.25 debt service coverage ratio. Uh,
Interesting.
so yeah, I mean, you have to Google it. We can't spin off into that direction, but
Yeah, DSCR, yeah, for those,
yeah,
right?
yeah. So yeah, but in that case, that could support a firm being worth 4 to 4.5 times the adjusted EBITDA, which is going to be the net profit plus your depreciation, amortization, interest, taxes, and your salary and benefits.
And I'm assuming also if there's some sort of like a car or like so whatever personal, some of the personal stuff that may be in there, it gets backed out in that calculation as well.
Yeah, you can add that. You can add that back as well. Yeah, we do add that back when we're going to market to show a full
Right.
add back schedule. When it comes to vetting a business on the buy side, I wouldn't think too much about that. I would really only look at the net profit with the EBITDA add backs and the owner's comp. Because if the owner pays for their car, you're probably going to write your car off too. If they pay for their cell phone, you're
Sure.
probably going to do that too. You're probably going to have to spend some money on marketing because you don't have the network that the owner had.
Right.
So yeah, when you make the adjustments to what your owner discretionary earnings will be as well, you find that it ends up roughly the same.
So when you're analyzing something on the buyer side, and you're having somebody buy something, I keep getting ads. I'm still subscribed to that. I think a TPS or whatever. I forgot the name of the company that does the sales and keeps listing them. What are you looking at for your buyer? You're looking at the composition of what you just described, the recurring, reoccurring,
Yep.
and then are you kind of putting in some sort of like factoring for people who will just fall off, who will just drop away because Bob is not there anymore?
Yeah, for sure. So first, when I'm talking to a buyer, especially if they're a non-accountant, so we have to determine if they're an accountant or a non-accountant. And if they are an accountant, are they the relevant type of accounting professional? Because we have a lot of auditors are buying tax firms. That doesn't really do them any good. It might as well be any other non-accountant.
Yeah.
So accounting is effectively three systems. It's the fulfillment system, the talent system, and the sales and marketing system. So if you are a tax professional buying a tax firm, that's perfect. You can get in, you can do the tax work, but you have to find a way to do sales and marketing and hiring to grow. If you're not a tax professional, it's fine. Find a firm that has really good tax professionals who will stick around, but make sure that you are a master at either sales and marketing or hiring, training, and retaining talent. As if you can do one
Interesting.
of those things, then you can run a firm. So that kind of kicks us off as to what we're looking for. Then it comes down to how technical the buyer is. So if you are a tax professional with a lot of experience, maybe we look at something that has a more elevated niche focus, like a trust and estate firm.
Mm.
If you're a little bit newer to the industry, or you've been enjoying a lifestyle, I posted about this too. Just go follow me and like read all my posts. But
Yeah.
the your ability to scale a firm, your firm's ability to do work is different than yours. Like you may be able to do the most complicated trust returns in the world, but the likelihood of being able to hire people at scale to do that work just isn't very high.
Mm.
So
Yeah.
a lot of technical buyers have to humble themselves a little bit and say, you know what, we are just going to do basic partnership returns, or maybe 1040s for investors that have some additional schedules, but not the high level technical stuff that they're accustomed to. You just can't build a firm around that really high level work unless you just have an incredible network. So that's where we look at service mix. How much tax versus bookkeeping, and if you're doing tax, how much is split between individual, business, estates, and trusts. And we also look at the opportunity there. So, like, I come from a tax background, but I much prefer upselling bookkeeping services. So
Mm.
I would buy a tax firm all day long that has low bookkeeping revenue, but a really high demographic in business tax prep clients. Business, I could just upsell
Yeah.
bookkeeping all day long there.
I like
So,
that.
so that's what we start to consider. And then there's a flip side to that. Say you're looking at a traditional firm, or maybe a tech-enabled firm that does a little bit of audit, just CPA owner. So maybe they do 5% of their revenues audit and attest. You have to consider how much of the bookkeeping and tax prep comes from those same clients, because if you're a non-accountant or non-CPA, even if you're an EA, and you're gonna
Yeah.
move away from that audit and attest work, how much of the rest of the revenue are you gonna lose? And then
Right.
there's always a little bit of attrition anyway, just because you know, seller Tom's golfing buddy Bob is,
Right.
the biggest client.
Yeah. Interesting. That's some really, really interesting fundamentals to consider. What's your take on clawback provisions, and are you seeing those
Yeah, yeah,
also?
yeah. It's very common. Most deals that I see done, especially in the Main Street space, which is going to be like 0 to 5 million, 0 to 10 million, it's going to be a lot of them will be on an SBA program or a conventional loan that's done by SBA type lenders, so kind of similar profile to that loan. So that means you're putting 10% down. You'll most likely have a 10% seller's note. It's just become very, very customary. It's a way to de-risk it a little bit for the bank, because the seller's saying, I'm confident that this is going to stay stable, so I'm going to go for the ride a little bit. And then depending on what your concentration risk is, both key man with your employees, the activity of the seller, how many jobs that seller's holding. You may have anywhere from 100,000 to a few 100,000 in an escrow holdback for a period of time, just to make sure you're covering yourself. But
Yeah.
that's one of the trickiest parts when it comes to buying a firm, is how much work the owner's doing. Because like, you may not just need to replace a senior tax professional. You might also need HR and sales, and you might have a lot of roles you're trying to fill to replace that seller. So a big red flag to me is when I meet a buyer who thinks they're going to buy an accounting firm and be an absentee owner. It's like,
Oh yeah, like a
get
passive.
out
Yeah,
of here.
accounting firms
Yeah.
are not a passive, unless I suppose you buy a firm that's already has all the people in place, and
Yeah, it
like
had
you
to be a
said,
monster firm.
a monster firm, and
But
like you said, then you
yeah,
have
and
to
then
manage people.
even those you have like no shot if you're an individual. Because if you're
Right.
buying a firm that's that well established, there's just too many private equity backed roll ups out there that
Mm.
will just they'll write a like blank check. I mean, they're paying so much, six,
Wow.
8 times adjusted EBITDA.
Wow. So that leads me to my kind of where I was thinking to go next, which is where do you see, from what you've seen out there, like where do you see the deals kind of dying, or not coming through to the closing table?
Yeah, so I kind of alluded to it a little bit. before I got into M&A, so I started offering M&A services as a niche focus for CFO, but before I decided to get into the space properly, I spent about a quarter, about 3 months looking to buy a firm myself. And I had my own deal that was under LOI that fell through for two really critical reasons. The key staff accountant was ready to retire, and she basically said she was going to retire as soon as the owner did. And when I looked at their salaries, these like staff accountants with 20 years of experience were making like 40 grand a year. So
Wow.
to replace them was going to cost 80 minimum each.
Yeah.
And that's where I got the audit thing from. The 5% of audit was attached to 25% of the revenue.
Wow.
So luckily I had a background in this. So as I built the financial model, the cash flow was just whittling away as I was assessing the risk. And so
Wow.
those are the key areas that I recommend people to look at. And that's a reason that non-accountants should be very cautious when going into this. Great
Yeah.
asset to invest in. But, make sure you have somebody looking at the numbers for you.
Yeah. This is really good considerations. What about, I've been getting a ton, not a ton, but a decent amount of folks who reach out to me and ask me, is buying a firm a good way to start in my entrepreneurial journey? So, they might be somebody who has 10, 15 years experience. Maybe they're a senior manager right now at a public accounting firm. They obviously have the technical wherewithal, but they're scared to, go out there from zero. In my mind, there's obviously positives and negatives of buying a firm versus building it yourself. But what is your advice to them? Should they buy a firm, and what kind of firm should they be looking at?
You should 100% buy a firm, and not this is me like less biased. I am biased, but I have a good reason for it. So you should 100% buy a firm, and here's the reason why. Growth from 0 to 1 million is extraordinarily difficult. It's probably the most difficult point in time that you will have as the owner of an accounting firm. Because from 0 to 1 million, you're just like you alluded to, you're just too cash strapped. So you're
Yeah.
like you're always either overstaffed, or you either have too much staff, or you have people who are working overtime
Yeah.
trying to get to that million. Once you get to 1 million, then you should have enough margin. You can afford to hire someone and let them sit at half capacity, and it's not going to kill you. But before 1 million, you can't afford to have a preparer, a bookkeeper, an accountant at half capacity. So if you have some savings or some inheritance or whatever, if you got a little bit of money, there's a great loan program. I mentioned it before. It's the SBA 7A loan program. You can buy a firm. You can get up to $5 million on a loan.
Wow.
It's 10% down. So if you got $100,000, you buy $1 million business. It's probably a firm doing $1 million in revenue, right? So you just jump the line. You don't have to worry about any of that stress for the first 5 years of firm ownership. If you don't have $100,000, then just start, build the lifestyle firm, get up to $200,000 of revenue or so, and then go meet with an SBA lender who will give you an expansion loan where they'll use the value of the firm that you have bootstrapped to then get into a business without having to put any money down.
Wow.
And you can just leapfrog that 0 to 1 million or 200 to $1 million revenue slog that you'll otherwise have to go through.
Interesting. And what should those people look out for as they're analyzing these deals? Short of, obviously, they should reach out to you. There's no doubt about that to get that. But if they're looking for some of that guidance and something to look out for in $1 million firm, what would that be?
Yeah, I mean, just make sure that you're looking at a firm that don't rush. Be patient. Look at the details. Don't be afraid to back out. No deal is better than a bad deal. So
True.
just back out if it's not looking right. Don't put yourself in a bad spot. Taking out a big loan like that, I just kind of very quickly said just do it. Everyone should do it, but it is something that you have to consider. That's a huge loan. So you want to make sure that there's enough cash flow from the business to pay for the loan comfortably. Not just what the bank will let you do, because the bank. I love the bankers out there. There's only a few of them that work in this niche, so I love you guys. But banks will let you get into some crazy situations. So Yeah, make sure
unfortunately.
you consider what kind of working capital you need. Make sure you consider what kind of additional investment you're going to have to make, and try to find a firm that can cash flow it. And there's a lot of firm owners out there who are very passionate about who the next steward of their firm is going to be. So they'll stick around for a year or more to help you out. So look for a good seller that's that cares about their people, cares about their clients, and they want to help you be successful.
I like that. That's cool. Some really good advice. Because yeah, you know what? Everybody wants that like magic bullet or a magic thing that's gonna like propel them into firm ownership with the least amount of headache and have them make the same money they were making as a insert title at
Yeah.
public accounting firm. So yeah, I mean, definitely can see your point. Let me ask you, what's your take on PE in general? I know you alluded to it a little bit. What's your take on like PE in accounting, high level, good, bad? What's it going to do to the profession?
I mean, I there's a lot of bad. I think more bad than good, but I don't think that it's going to have any real lasting impacts on the profession. I mean, we just saw this. I'm not in the HVAC space very heavily, but I know enough people who are investors in the space, who are brokers in the space. And PE got really into HVAC for years. I mean, all the way down to businesses that were doing 100,000 or 500,000 in EBITDA, which is like super small. Usually PE won't go below like 3 million in EBITDA, but
Wow.
and they're doing that in accounting too. But then they kind of pulled out, and we just like from what I'm hearing in the industry, private equity just isn't buying HVAC like it was before, and I think that's going to be really similar with accounting. I think that it's hot and heavy right now, and they're going all the way down to 500,000 in EBITDA. But eventually, private equity, there's only so many of them out there, and they all have mandates to sell after 5 years or so. So
Yeah.
we're starting to get toward the end of that timeline to where private equity is going to start to look somewhere else. Um,
I'm
but
yeah, because I'm curious. Like when I looked at it and I see these firms being acquired, the biggest impact that's negative to me is the people,
yeah,
and them being pushed harder and all this EBITDA crunch because they're all trying to get to the higher EBITDA so they can flip it. But my thought has always been like, how many times can they really flip this? Like you can't pot
yeah,
like
it's
okay, maybe you get to three. I mean, four to me is like unfathomable because like
what do you
really
mean the three
like
or
four
four?
flips, three or four
Oh,
flips. Like I mean, like
yeah, they're all. It's a
I don't.
roll up. So they're
It's a
rolling
roll.
them up. Yeah. So what's happening is that like let's say a firm that's doing less than 1 million in EBITDA is worth. I said it before. Let's say 4 times.
Yeah,
So like we'll say it's a bookkeeping firm that's like super sharp, great with tech.
yeah,
They're worth 4 times EBITDA, sub 1 million. Once you
yeah.
go over 1 million, now you're probably worth 6 times. Once you go over 2 million, you might be worth 8 times. Once you get over
Wow.
3 million, you could be worth 10 times. So rather than buying and building these firms, they'll just go buy three firms doing 500,000. So small, like micro PE, will buy
Yeah.
three firms doing 500, and then at 4x, and then they'll flip that 1.5 at 6x. And another private equity
Mm.
group will buy that. They'll buy three of those doing
Oh,
1.5, and they'll flip it for 8x. And then a bigger private equity group will do it again. And then you start to get to like the legit private equity groups that have hundreds of millions of dollars in the bank, and they're the ones that are buying the 10 and 20 million dollar firms, and they're bundling them together and selling them up.
interesting. Because the way when I look at it, I think of the big boys. I think of like the Eisner Ampers out there, the Citrons, the all those bigger people firms that sold to PE.
Yeah.
You know, but I mean, I don't know if that's necessarily that's who I think of when I think about the flips, right? Because I mean, I don't know if they're doing necessarily roll ups with that big of a firm, you know. But eventually, that's my point. What I was saying. Eventually, the pot runs out, right? Like eventually, who are you going to flip it to next? At
Somebody's
its
going to do a
current,
long-term hold. Like eventually a family office will buy it, or some large corporate will buy a big four. And there's a lot of, and this is something I only learned once I got in the industry. There's a lot of
yeah,
private equity groups that you just never heard the name of, and they may own firms that you have heard the name of. They don't
yeah,
always rebrand. You don't always hear that it happened. So
interesting.
there's some pretty large companies out there in the accounting space that are owned by private equity groups that I had no idea were owned
Wow.
by private equity groups.
Yeah. It's very interesting. It's eye opening in some respect. You got me thinking about buying a firm. No, I don't know. I don't think I don't think I would do it.
Yeah. But just like
But
as a company, we don't sell to private equity, and we typically don't work with sellers who want to sell to private equity anyway, so it's kind of a non-issue. But we have a deal underway now that I wish I could talk about more. But private equity, it was exclusively to private equity. It was the deal is going to end up going for around 9 million.
wow.
But we were exclusively looking at private equity backed roll ups. So the first conversation I had with any of the private equity reps was like, well, let's have a second call with your operator because we
Mhm.
want to know what the culture is, what are their corporate values. So
Yeah,
private equity doesn't have to be a bad thing if they've got a good operator.
got it. Interesting. What I just what you just said got me thinking. Like, what is an interesting story that you could share from maybe a prior deal or something unique or something, just something interesting on like a deal that the listeners would get some value from. Maybe something unique, maybe something, like I said, that you can talk about, obviously.
Yeah, I think so. Speaking to potentially the non-accountants or the CPAs who feel like they don't have the right experience, or like even EAs, one of the best deals I've done. It wasn't the biggest deal. It wasn't. I don't know. There's only one reason why it became the best deal in my opinion, and it's the deal that started RightExit. Like in terms of the brand, the reason
Mm,
why we do business was like solidified by this one deal. And it was a seller. He had bootstrapped a lifestyle firm, had the opportunity to absorb another book of business, and then built that to 1.5 million,
wow.
and did very well. He had his revenue per full time employee was a little bit low, but it was more of a traditional side firm. They were getting into some tech stuff, so they were going to fix that. But he got it in his ear that he needed to buy another firm to grow.
Mm,
So he bought another firm doing 1.5 million in revenue. So doubled his staff, doubled his revenue,
wow.
doubled his client base all overnight, and is extremely stressful. And so he got introduced to me to try to find a buyer. And like most sellers of CPA firms, he's like, "All right, I just need you to find me a CPA to come in and buy this
Mm,
who has energy and fresh eyes and
yeah.
can do something with this." And I took a look at it, and being a non CPA myself, I was like, I don't think a CPA is the background that's going to fix this problem.
Yeah.
So luckily, I have a pretty solid network of accounting firm buyers, and a handful of them are change management consultants from Big Four. So we brought in five potential buyers. Three of them were former change management consultants, and the CPA buyers looked at it and were like, I don't know, like, this is gonna be a lot. The change
Yeah.
management consultants looked at it and they were like, another day in the office. Like, this is no big deal. We can finish this
Interesting.
integration. And so had a phenomenal buyer. Yeah, used to work on Capitol Hill doing tax legislature, like knows the tax world, but wasn't a tax professional himself. Did some change management at Deloitte. He bought it, finished the integration, and he's ready to buy another one. So
Wow.
I think I think the lesson from that is that there is a right buyer, and every deal has a right buyer, a right price, and a right time. It's just about figuring out who that is. So on the sell side, taking the time, going through a lot of buyers, working with advisor, intermediary who's going to go through the process of finding you the right fit, the right steward to take over your legacy. And on the buy side, it's just about figuring out who you are as a professional and where you plug in. And don't push yourself to take on something that's going to put you underwater. Take on
Yeah.
something that looks like a fun challenge.
Yeah. That's a really good segue to that too. And I especially, and not necessarily even underwater as far as like, financially, but underwater as far as your stress levels and, and considering what you're leaving, whatever it is, firm, comfort, security, whatever it is, for, working twice or whatever it is. Just have the valuation and look internally to yourself to understand what you want for yourself as a firm owner and follow that. And with that, man, thank you so much for coming on to the show. Where can the people find you and who should find you?
Yeah, so anybody that's interested in buying and selling accounting firms or buying and selling any business, I'm happy to help. You can look me up, Daniel Talbott, on LinkedIn. I should come up first. Shouldn't be hard to find there. Or RightExit.com.
Awesome. Easy enough. Well, I appreciate you again for coming through the show. Thank you so much for this. This has been eye-opening in many ways, and I hope the listeners get some value out of it.
Yeah, thanks for having me.
You got it, man.